Our goal is not only to discuss the challenges, but also to explore practical pathways for founders, investors, policymakers, and institutions to strengthen Africa's innovative economy sustainability. Thank you all for joining us. Please, in the comment section, you can introduce yourself, tell us your name, where you are joining in from, and how you got to know about the webinar. You can do that in the comments section. Before we dive into individual perspective, I would like to begin with one broad question for everyone. When you look at Africa's innovative, okay, technical, please, you can play the introductory audio. Thank you.
Ebunoluwa Ashley-Dejo. Ebunoluwa Ashley-Dejo is a business analyst, researcher, and writer focused on how organizations turn data into better decisions. Based in Massachusetts, she brings experience spanning banking, higher education, and technology, with a strong emphasis on operational efficiency and customer insight. She holds a master's degree in business analytics from the University of Massachusetts Amherst and has published IEEE research on intelligent systems. Through her writing, including her publication Operational Intelligence, she explores the growing data divide between large enterprises and small businesses, and advocates for practical, accessible analytics frameworks that drive real-world impact. Damilare Davola. Davola is a seasoned investment. Ebunoluwa Ashley-Dejo. Ebunoluwa Ashley-Dejo is a business analyst, researcher, and writer focused on how organizations turn data into better decisions. Based in Massachusetts, she brings experience spanning banking, higher education, and technology, with a strong emphasis on operational efficiency and customer insight. She holds a master's degree in business analytics from the University of Massachusetts Amherst and has published IEEE research on intelligent systems. Through her writing, including her publication Operational Intelligence, she explores the growing data divide between large enterprises and small businesses, and advocates for practical, accessible analytics frameworks that drive real-world impact. Damilare Davola. Davola is a seasoned investment banking and business analyst with extensive expertise in technological research, strategic analysis, and emerging market trends. Success Ajilore. Success Ajilore is a seasoned accounting and business analysis professional who has spanned over 11 years in the industry, using her exceptional skills to manage client portfolios and solve complex audit technicalities for multiple clients.
Thank you very much, Technical, for that introductory audio sharing our speaker's bio. So I was about to ask a very broad question for everyone. When you look at Africa's innovation ecosystem today, what do you believe is the single biggest barrier preventing startups and SMEs from accessing sustainable financing at scale? We can use the chat box. So what do you think is the biggest challenge that is preventing startups, businesses, when at the beginning to access sustainable financing to scale up their businesses? Please, you can use the chat box. Okay, while that is going on, I would like to quickly continue and bring on the first speaker, Damilare Davola. Am I correct by the surname? We can correct this name.
Yes, you're correct. You're correct. That's fine.
Okay, thank you, Dami. Dami, let me begin with you from investment banking and financing perspective. So how would you assess the current state of the startup financing across Africa?
Thank you very much, Oluwatosin. I'll start by saying that Africa is a very large geography, as anyone on this call might know. And so there are different experiences across different sub geographies within the continent. And one of the more interesting things to observe, or that could have been observed over the last couple of years, is that West Africa, South Africa as a country, not the Southern African region, and some parts of East Africa seem to be the flag bearers of innovation and of startup progress on the continent. And even though that's a feat of its own, I think there's a lot of limitation that comes across from that. Like, so when people think about African startups, they think of Flutterwave, they think of Money Point, they think of the very obvious ones. And I think over the last 20 years, Africa has only been able to produce somewhere in the ballpark of 10 to 15 unicorns. We're super thankful for that, super grateful, but it's at another level of analysis, it is insufficient, and it's a proof that there is something that is inherently lacking in the way the continent, maybe via our cultural or socioeconomic reality, has structured itself, is providing value to the world. So the more a company or a startup provides value to the world, the more it becomes valuable, right? That's a 1-to-1 ratio. And so when you hear unicorn, all that is being said is that this company is providing a lot of value to a lot of people. And so when we look at the lack of numerous unicorns across the continent, right? This is a continent we are the either the first or the second most populous continent in the world. So we have a lot of people, and the majority of these people are young people. And so if we have a lot of people, and all these lot of people are very young, and the level of innovation that is being produced from these young people is very limited, I think it says a lot about the state we're in, and it calls for deep reflection. Now, to attack your point, more head on, I would say that there is some form of, and this might be a contrarian approach, or something that looks a bit more antagonistic, but that's not my intention. My intention is to shed as much light as I can from my perspective. There was a wave of financing that came on the scene in Africa a couple of years ago, from around 2014, 15, where Paystack, Flutterwave, all of them were getting funded. And that opened up the horizon to young people, for them to be able to aspire, to be able to imagine, to be able to see that, oh, wow, this is possible. You can do this in Africa. Foreign investors can invest in your money, blah, blah, blah. And so what did people do? They did the easiest thing to do, which is to copy, right? So everyone started trying to copy the playbook that Paystack and Flutterwave and all the fintechs were doing, right? The early 2020s and the late 2010s was like the fintech boom in Nigeria. Everyone and their grandma was opening and launching a fintech, right? And what that just did is to condition people that, okay, if you want quick money, if you want dollars, or if you want pounds, go start up a fintech, right? Ignoring the reality of the actual problems that they had on ground. And we're still tasting the backlash of that as a continent till now. Because with the exception of maybe Childec and a couple of other innovative startups here and there, most people in Africa, most startups are trying to solve fintech problem, financial technology, right? That's an overbeaten horse. Can we move on to something else? There's so many problems, so many issues. To speak to what you were mentioning, Tosin, today, you mentioned that the host of the show is not here at this moment because of network issues. Network issues have plagued Africa for as long as I've been alive, probably longer than that. Why isn't there any startup trying to disrupt that? Jobs are clearly one of the problems that spiral to, the insecurity, it has many second and third order effects. Most people are not trying to tackle that. There was Andela that tackled it in the, 2010s and all of that. And then, a couple of startups here and there. Those are not getting the required funding. Why? Because they don't look venture fundable. I'll summarize my question so that you can move on to the next question, and to the next person you want to talk to. But by venture fundable, what I mean is venture capitalists have a playbook. They have a mold of what they are looking for. Can I put 100 million naira or dollars, whichever, into this business and live with 300, 400, 500 in the next 7 to 10 years? If yes, okay, let me do that. And it's easy, or it was easy with fintech. But then there are more serious problems that need funding that would also be very profitable, but it would just take a longer period of time. And it'll be a bit more risky. So if you're going to tackle power, for example, electrical power in Africa, yeah, you're going to fight with a couple of cabals. There are some people who are institutionalized to ensure that the system continues the way it is. But an intelligent startup can tackle that successfully. Now, would that startup be funded enough? No one wants to take the risk. Or we could take, justice. It's crazy. I had this very interesting thought recently, which is that, the idea of injustice or, social injustice, blah, blah. A startup can fix it. You can, like, it just takes the brave, is it braveness or brevity? I don't know. But it takes the quality of braveness, yes, braveness, to be able to actually think of how to solve the problem. I'll give you an example. Someone can create an application now that is, crowd justice, something like that, just as an example, where if you see an injustice somewhere, you can report it anonymously. People can vote on it, right? I'm making this up as I'm just saying it, like I haven't pre-thought of this, but it's like so many problems that surround us as Africans, but we are going to the easiest solution, the one that has been funded in the past. So being the copycat is the easy way out, but then we suffer for it by having, now there's a higher bar to be a copycat because everybody knows AI now can create easy applications. So even the fintech that everyone is running to, there's less of funding in that direction. And so the investors are sitting with money. Venture capitalists have a lot of money. I'll be the one to say that, right? They have a lot of money. The LPs, the limited partners that give the venture capitalists money, they also have a lot of money. Everyone is sitting down on their hands and saying, where do we put it? We don't want to just give it to another guy who is going to come and tell us they want to bank the unbankless and they'll run away with our money, right? We need people who are trying to solve actual practical problems. And the moment those people emerge, I've had conversation with a couple of them and I know that they exist in Africa, but they are a very underrepresented silo. They are all siloed across different places in Africa. And that's also a problem that could be solved. So a startup can try to connect Africa's brightest minds with incentive structures. You can pitch this to, the world is, decentralized now and it's globalized. You can pitch to foreign investors from the comfort of your home in Africa. And if you have a solid enough proposition, if you have an intelligent enough angle, if you can show the profitability of this, like just what I just said now, connecting Africa's brightest mind, it may seem like just an ordinary proposition. But what is YC? The accelerator, startup accelerator. That's what it's doing. It's connecting the brightest mind in the world and it's funding them. You can do that in Africa. Would it be more risky? Yes, but that's the point. The point of venture capitalism is to fund an adventure. But then if you're not taking on risk, then it's no longer an adventure. You're just trying to copy, plug and play. And doing that is going to keep the economy low. It's going to keep our ability to think, our ability to solve problems, it's going to keep it under a lid. And to transcend all of that, the African innovators, the African founders have to think, they have to dream, they have to have the bravery, the courage to be able to tackle the toughest problems facing their environment that they are facing. It's not everything that's going to be logistics and fintech. And then the investors have to have also the capacity to take risks. You have to believe. You have to take a shot. And in doing all of that, I think Africa would experience its next wave of innovation inevitably.
Thank you, Dami, for that extensive answer you gave to the first question. But quickly, before I move on to the next speaker, you really pinpointed on foreign investments by young people, and it's true, we've had a lot of, it's just like everyone is challenging, trying to solve financial problems. Meanwhile, we have Africa has numerous problems to solve. And looking at the telecommunication sector, how many fully Nigerian owned telecommunications companies do we even have? Not That's even Nigeria, not even speaking about Africa. why do you think Africa is still relying heavily on foreign venture capital?
That's an excellent question. First off, fortunately or unfortunately, the whole world, right, relies in one way or the other on the dollar. And what this means is that this dollar that everyone is requiring on, wherever or whoever can print the most of it or generate the most of it, controls how other people respond, right, financially, economically. And so, as long as the world has the petrodollar or the US dollar as its standard for global trade, every other country that relies on that for some form of foreign exchange is subject to the power of the dollar. And so if you and I were to start certain VC, so you wanted to start Oluwatosin VC in Africa, and I wanted to start Dami VC in Silicon Valley, I may not have better ideas than you do. I may not have better research capacity as you do. But if I have $1, you would have to require 1,500 naira, right? So the foreign exchange is first not in your favor. If I'm raising, I don't know, $1,000, that's easy. I can do that over a call. It was not even going to be a problem. Over a call to a friend, right? I won't even consider it. In fact, $10,000, I can do that with a friend. $100,000, I can do that within 3 friends. But to the African, $100,000 is a lot of money. You require speaking, convincing, proving, providing your birth certificate, proving, like you're literally going to prove so much just to get 100K. Right? So there's the foreign exchange imbalance, 1. 2, then there's the capacity for risk. Let's not forget that these Western countries are the people who have built the infrastructures that most of us are using today. So their history is replete with men who have taken risks. There's a documentary called Men Who Built America. You'd benefit if you watch it, right? Or if anyone here has watched it, they can agree to that. You see how so many systemic and calculated risks have been taken by these men in the past. And so they have a cultural history of taking risks to improve their situation. They can gamble. I don't want to use the word, but that's ultimately what it is, right? They can gamble intelligently to be able to solve problems with the bet that the situation that they are in before that gamble would be much less preferable than the situation they will be after the gamble. Basically, what that means is they are betting that the gamble is going to pay off and they will live a better life after than before the gamble. Now, come to Africa. Most people that can generate that amount of money will either have some connection in the US as well. Like, so when you think about the unicorns in Africa, all of them have US investors. All of them are foreign investors. So technically, we can debate here, even though that's a conversation for another day, we can debate whether or not those companies are actually African owned or they are just African faced. They just have an African face there. If I own 80% of your company and I'm Russian and you are Nigerian, you now claim that because you are the CEO, you are the company is a Nigerian company. Of course, it's not a Nigerian company. I own 80% of it. It's Russian owned. It's just Nigerian faced. I put you there. So yeah, but that's a conversation for another day. So in closing, I'll say that the risk capacity that the African VC can take is also limited by its ability to raise funds. The limited partners, the LPs that VCs collect their money from, the ones in America have a ton of money. They have, like, they can take a risk of 1 billion and forget about it. By the time the African VC has raised $1 billion for you, he's going to be sitting with you in your he's going to sit in your office and be telling you what to do, even because that's a lot of money to him. And so yes, there's the financial part, there's the cultural part, and then there's the risk-taking ability. And I think all these can be corrected for in a long enough timeline where we can start changing the conversation, but not only a conversation, right? I don't like solutions that talk about changing conversations. We can also incentivize structures where the African can partner with, I don't know, an international body for a longer time frame. So you can borrow that 1 billion, but you pay back in 20 years. It's possible. The IMF does it with countries. So we can have other LPs do that with VCs as well. You partner for longer time frames so that they can give you time. They can let you breathe. That way, the VC that is doing the giving of the money to the startups can be African, but his LP is just foreign. And we also have billionaires. Like there's a new billionaire class emerging in Africa now. We can get those people to also fund VCs. It's just the conversations we are going to have to put in front of them. We'll let them know that, look, you have XYZ $billion. Here is an industry. In 10 years, guarantee 5x. Here are the risks. Blah, blah, blah. This is the risk profile. Blah, 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 blah. We show them that. Not all of them will say yes, but we need just one yes to kick the ball rolling in the right direction. And I think conversations like this, events like this, would ultimately be the catalyst to push the ball in that right direction.
Thank you very much, Dami. I know all our speakers there we have great insights to share, but 1 hour can't do justice to it. So let's try as much as possible to keep it short. Thank you, Dami. My next question is directed to Ebunoluwa. So, Ebunoluwa, can you hear me?
Yes, I can hear you. Can you hear me?
Okay.
I'm sorry, like I'm currently in transit right now. I've been traveling all morning and I have to come to Starbucks here to just answer the meeting. I'm so sorry. Can you hear me?
Okay, that's fine. I can hear you very
All
clearly.
right.
So let's bring in data analytics and operation intelligence perspective into this topic. You've written extensively about growing data divide between the large enterprise and small businesses. So how serious is this gap in Africa today, and what risks do you think it poses for?
What's the last question? I'm sorry.
Okay, I said you've written a lot extensively about data divide, growing the data divide between the large enterprise and small businesses, the SMEs. So how serious do you think is this gap in Africa today, and what risks do you think it poses for innovation?
All right. So I think the gap is very serious, right? And sometimes I think we also underestimate it. So because large companies are making decisions with dashboards, like I'm in business analytics, right? So we use dashboards to create stories, to tell stories, and all. And then so with dashboards, customer data, right? And then also forecasting tools. So, but many small businesses, they are still making decisions based on memory, right, and instinct. So, like before business analytics or dashboard came into like existence. So, and I don't know. So right now they are currently trying to settle into it, right? So I feel like at the end of the day, that creates a real disadvantage. So it means that so the big companies they keep getting smarter while the small companies keep reacting. So as for innovation, um, the the risky part is that many African SMEs they have great ideas, but they don't have that data structure to put the growth. Do you understand what I mean? And then so that would probably maybe I think attract funding and also maybe scale sustainably.
Okay, thank you. Thank you
Right.
very much, Ebo. And that's okay. We need data to fuel your idea and
Yeah.
help you to get your funding. I'll come back to you. I'll quickly move on to success. Success, can you hear me?
I can hear you clearly, like you are breaking, but I could hear the other voice clearly. Yeah.
Okay. I said I'll come back to you. I want to
Okay,
move
okay.
yes, to the next
Okay.
speaker.
All
Thank
right.
you. Yes. So I'd like us to examine the entrepreneur development and financial management side of this conversation. You have over a decade experience in accounting and business analysis. How would you describe the biggest financial management problems facing African startups today?
All right. Good evening, everyone. Good morning, good afternoon. I am watching from. I'm happy to be part of the tech economy because that's the future. It has gotten to a point where so many startups now are trying to even consider that route of automating their businesses and providing their services faster and smarter. So from my experience as a chartered accountant and business analyst, I feel that the biggest financial management gap in African startups is actually the lack of structured financial systems that supports the sustainability. It's not just about record keeping. It's about even keeping the record according to the regulations of the environment you find yourself. Many founders confuse revenue growth with business health. They operate without proper cash flow forecasting. If you can forecast your cash flow, you have solved your future problems as a business. And they also confuse what scaling really means. So apart from confusing revenue growth with business health, operate without proper cash flow forecasting, and also they scale without understanding unit economics or profitability drivers. Now, for every product or service, you need to be able to separate each product, each service, and be able to identify the profitability of each of those products as if it's a project. This leads to businesses that look successful outside, externally, but are financially fragile internally. If anything goes wrong, they are back to the ground. A practical Nigerian example could be 54G, which attracted like global attention and funding, actually attracted funding, but later faced restructuring challenges, partly due to pressures from scaling faster than its financial system. Like somebody that started a business decided to just decide that, okay, I have the idea, I have the vision, I just need an accountant, and not just an accountant, an experienced accountant, just to make sure that the financial forecasting, the profitability is transparent. I'm not confused about it. And also it attracted global attention, it attracted funding, but later faced restructuring challenges, as I said, partly due to pressures scaling faster than its financial system, also scaled faster than its cost structure and long-term sustainability planning that could support it. So the lesson is clear. Without strong financial discipline, which many startups, which many entrepreneurs lack, without strong financial discipline, corporate governance, and cash flow control, even a well-funded startup can struggle to survive.
Okay. Thank you very much, Success, for that insightful words shared. And I can see you from your experience mentoring entrepreneurs through STN, you've already shared like common mistakes founders make when preparing to seek funding. I want you to explain how important is financial discipline, proper accounting structure in attracting the right investors and lenders.
It's important for anybody that is going into business and wants to attract investors to understand what venture capitalists are looking out for. Now, venture capitalists are not only interested in investing in ideas, they're interested in investing in businesses that can grow sustainably, generate returns, and survive challenges. Every venture capitalist must have even studied the environment and the economic environment of where they are investing in, so they know the challenges. So the question is, this company I want to invest in, does the people running this business even understand the challenge? As an African startup seeking investment, there are some key things that investors actually expect. First of all, they want to know if you have a clear problem you want to solve. If you have a real solution that your business wants to bring to the table and to the global space. Most investors will look at a local business that maybe is solving problems and would like to invest and scale it up to solve the problems globally. Now, they also look out for strong financial discipline. Just look out for how are your books, even in the face of tax regulators? Because sometimes your books are good, but in the face of audit and tax regulators, they are nowhere to be found. They lack integrity. They're also looking out for scalable business model. How scalable is this your business model? They are looking out for clear revenue. What really makes your income, and how sustainable is that? Can that income continue? They're looking out for profitability part. And they're looking out for strong leadership and governance. They're also looking out for market validation, risk awareness. Sometimes they ask for your risk register. Have you even assessed the risk around your business? So those are the things they are looking for. Now, for the importance of financial discipline and proper accounting structure, it's so critical because a wise investor will not want to invest in your business without this financial discipline demonstrated. They want to see transparency. They want to see predictability. And some may get to the point of even involving AI and data analysis to see the trend of your data. So, businesses with organized bookkeeping, budgeting systems, compliance records, and reliable reporting inspire confidence in the mind of investors. Nigerian companies like InterSwitch gained stronger institutional trust, partly because of structured governance, partly because of compliance systems, partly because of financial controls that supported sustainable business. So that's how important it is.
Thank you very much, Sota. You really shared a lot. And one of the points I'll take is risk evaluation. I think that's one thing a lot of startups don't really take into consideration. They don't take it as very serious. I'll come back to you. Dami, I'm back to you. I have a question that I think you need to really explain in details. What opportunities exist for institutional investors, pension funds, and local financial institutions to play a bigger role in financing innovation?
I mean, given the different nature of those organizations, like a pension fund is different from a bank, is different from, I forget the other one you mentioned, but they are fundamentally different organizations. However, they can very much and certainly do cooperate at the level of architecture. What I mean by that is, if you think about how financing works, right? When a VC is giving a company or a startup money, they are not necessary. Well, it depends on how the deal is structured. So you could have different structuring of certain deals, and that's where each of these organizations come in, right? So if you have I'm not too sure how a pension fund would would make sense in the equation, but the banks can certainly make sense there. And if you look at how they work or how they partner with the VCs and the LPs, then you can understand how intermediation works. So intermediation is when they are setting up the stage, right? What I was calling architecture for how the VCs and how the LPs will be able to get the money to the startups, and even how the startups can structure their own funding, right? So an example will be credit. A bank can give credit in a system that works, like in a system that has the sufficient infrastructure for that to happen. You could have asset bank financing, right? So where the startup could have a couple of assets, right? I was trying to think of an example of a startup that could function that way. And an example that comes to my mind would be a solar panel startup, right? So if there's a startup in Nigeria that is trying to fix power through solar, that startup could go for asset-backed financing. Say they invested upfront and they have a couple of solar farms, somewhere in some remote part of Nigeria. Instead of that startup to go the route every other person is going, you're now trying to pitch all over again. Now they could approach a bank, right, an investment bank, or even a regular type of bank, depending on the bank's capacity to be able to fund that. They could ask them for asset-backed financing, which just means they have an asset and that asset would become a collateral for the type of financing they want to receive. There's also something called revenues-based financing, which, just like the name implies, you take the existing revenue of the company, you then use it as some form of insurance, right, to be able to determine how much exposure would be reasonable for that entity to invest into the startup based on the revenue they have at the moment. There's something also called blended financing structure. You have venture debt, right, which is also part of the topic for today, which is pretty much when these companies have shown a sign of growth, right, a sign of life, like, okay, there's possibility, we see this can be a thing. What do? You're not necessarily only going to wait for a VC, right? Banks can step up, right? Insurance companies can step up and say, okay, we would give you a higher insurance rating, which allows you to have access to more capital from this. Would be able to give you receivables financing, right? Receivables financing is, so you're expecting some money to come in at a future time, right? You can finance based on that. All of these are they're just different types of financing, but essentially the point is they are promissory in nature. So it's like a promise, like based on how you guys look now, we can guarantee that, an investment of XYZ in you would make sense. And so those are the opportunities that exist for the institutional investors, the pension funds, the local financial institutions like the banks, the microfinance banks. It is pretty much betting on the company at a stage that then allows, maybe the company raising money from VC, it allows that to be easier, or because of the bets that the local institution or the institutional investor is making, it makes the startup more likely to survive. There was an interesting thing that happened, was it last week or 2 weeks ago, where the CEO of OpenAI started investing into, or at least, he gave startups that were in YC, Y Combinator, which is a startup accelerator in America. He gave them the option that, look, I would sell you OpenAI tokens, which are they are a word count essentially, or almost a word count for use of AI. So each time you use AI and there's a word, about 70% of that word is a token, right? So it was going to sell them free tokens to use OpenAI, and what would OpenAI get in return? A percentage in the company, right? So basically, that's a type of funding as well, and we're going to be seeing more of that into the future. The individuals or the startups now have to start thinking outside the box. Okay, how can I partner with this insurance company? Like, what could the insurance company need from me that would make sense for me to either give up some part of equity or make a deal with them, right? So now we're in the age of flexibility in thinking, and so thinking outside of the box would make those opportunities more apparent for the institutional investors, the local financing institutions, and the pension funds, etc.
Thank you very much, Dami. That was a lot you just shared right now. I'll still come back to you. Maybe that might even be my last question for you.
Okay.
And for the audience, if you have any question as we move along with the conversation, I'll request you send it in the chat box. So the questions can be noted down. I'll over to you, Eboluwa. So my next question to you, Ebunoluwa, is many investors now emphasize data-driven decision-making before funding startup. What operational metrics do you believe founders should pay more attention to? Ebunoluwa, you are muted.
Can you hear me?
Yes, I can hear you.
Oh, I'm sorry. Like I forgot I was
Oh,
muted. And I was
that's fine.
talking. Yeah. So you were saying, what metrics?
What metrics do you believe founders should pay more attention to when it comes to data-driven decision making before funding startups?
Yeah. So I honestly think that So the metrics would be coming from the business analytics point of view, like I mentioned earlier. So I would definitely say if we can use dashboard, right? And then to measure, because if we say we should check, what is it called, the venture debt, for example, right? So investors would want to, before they invest, right, they would want to look at some reports before they commit into some things, right? So they would want to look at maybe history, revenue history. They would want to look at customers' behavior, right? They would want to look at sales record and all of those. And we do not have that right now. Some of like, I think most businesses don't have that right now. But and when we are talking about Africa again, so it depends on the part in Africa. I lived in South Africa for a very long time, and I can tell you that like the structure is totally different, right? For example, like back at home, like the way we do things and more. So the metrics I would actually go for would be the dashboards, definitely. Like going into checking customers' retention, checking track record, and all of that. I don't know if I'm able to answer that question. Yeah.
Okay, thank you, Ebun. Just to buttress your answer
Yeah.
a bit, how can these small businesses we are talking about and startups build those practical analytical systems without massive budgets large corporations typically already have?
So without massive budgets. So let's not take out the fact that like that is not important, right? Budget is important.
Mm.
So, but I think that we just need operational structure actually. So I would give an example. So take for example, like the way things work in Africa is slightly different from the way things work like back here in the US. So for example, back at home, like we have like power supply issues, right? So if you now use a different model that Silicon Valley is using, and you want to use it in Africa, it's not really going to work. So I feel like honestly, the future of innovation, like the future of innovation financing in Africa, like I don't think the solution is like more budget or capital. You understand? I think that the solution is like better alignment between capital and then the reality. Because now we need like local capital, of course. We need venture debt, of course. So but we need something that would be able to, we need people that will be able to like understand the environment better. So local capital, on the other hand, is also important. That is like the budget part. So I think smarter financial structures that reflect how African businesses actually operate. So and also stronger operational visibility too would help. So because African entrepreneurs are already building incredible things. So the question is like whether our financial systems are evolving fast or to support them sustainably.
All right. Thank you, Ebon, for that explanation. Um, I'll come to you, Success. Still talking about venture debt. Venture debt is actually gaining attention globally. In practical terms, I want you to explain how African business owners responsibly leverage debt financing without harming their businesses.
Okay. A responsible use of venture debt is that African entrepreneurs can actually leverage it by using it for productive growth activities such as expansion. There should be a foundation. The real capital is in your mind, is in your dream, in your vision, is in the solution you want to bring to the table. So nobody can take that away from you. All you need is a leverage. So venture debt is supposed to be a leverage. It shouldn't just be given to any Tom, Dick, and Harry. It should be given to somebody who already knows where he's going and where his business is going. So when it enters into such a responsible person or system, it will definitely bring about expansion. So it's like if you're reaching out to a local community, by the time venture debt comes, you can now reach out to as many regions on your country as possible, reach out to countries, reach out to as many global markets that you were actually hoping to reach out. So it's supposed to solve the problem of expansion. It's supposed to also solve the challenges of inventory. So little capital, little inventory, more venture debt, more inventory. It's supposed to also help in your infrastructure. You should also look into how to now systemize your process, automate your process. You should be able to build a system where you don't have to be always available. It's already operating without you. Then it's supposed to also help in the working capital and operational needs, not for excessive lifestyle. That's not when you should be traveling abroad unnecessarily, and not for unstructured losses. Debt should only be taken when repayment capacity and cash flow visibility is strong. So several fintech, including businesses like InterSwitch, have shown the importance of balancing expansion with structured financial management. So that's how that's how to use venture debt responsibly.
Thank you, Success. So at the end of the day, operational structure is very important in managing your venture debt. My next question, which will be like my final question before your final words here. Looking ahead, how do you see local capital transforming Africa's ecosystem over the next few years?
Come again.
I said, how do you see local capital transforming Africa's entrepreneurial ecosystem over the next few years?
Okay, local capital has the potential to transform Africa's entrepreneurial ecosystem by reducing overdependency on foreign investors, supporting businesses that understand local realities. I will always say that the solution to Nigerian problems is inside Nigeria and by Nigeria. Many foreign companies that come here know what they are looking for. They know the mineral resources they are looking for. They know the human capital they are looking for. So they will come in the guise of foreign investments, and they will come and take more than what they are investing. So it is advisable for us to encourage local capital because they actually understand the economies around us. They already understand the challenges peculiar to us. So also as African pension funds, institutions, and wealth become more in startup financing, stronger ecosystems will emerge. I am looking forward to a Nigeria that looks at or considers using the Singaporean approach of looking inwards, solving inwards problems, and solving their problems inwardly. In fact, closing their system to outside, foreign, influences, and they were able to solve their problems. And now they are an enviable country. So they're an enviable. So we need to encourage local capital. Nigeria's growing fintech and SME ecosystem already shows local participation in innovation, funding, and enterprise support. So we need more local capital in Africa.
Sure. Thank you very much for those great words. We need more local capital in Africa as a whole. I'll move over to Damilola. So looking at your perspective from investment banking and innovation financing, what are the trends that are likely to shape Africa's startup ecosystem over the next 5 years?
Okay, with anything that has to do with trends, it's going to be difficult to pinpoint. But if we judge from where today is, we can tell where tomorrow is going, right? My answer is that it depends. And I know that's not as certain as you would like, or as certain as one would like an answer to be. It depends, right? It depends on the actions we take today. Let me explain what I mean. The actions we take today in whether or not we're going to pivot to solving practical problems, or okay, let me ask you this quick question, then I'll get back to my flow. What was when was the last time you saw a startup that you intuitively felt, oh my God, this startup is attempting what has not been done before? This startup is trying to solve a problem from a different angle. When was the last time?
It's hard to find.
And that exactly is the description
Yeah,
of what we are
hard to
looking at
find.
today. People just copy each other. Like, everyone wants to make quick money now, and I can't blame them, right? There's a sense in which aspiring to bigger things only follows suit after some level of survival has been catered to, right? But even that structure itself is a problem that could be solved. So a startup could arise tomorrow, and the goal that the startup is trying to do is to make sure that other founders can go for good ideas without suffering, like, where to live, where to eat, and all of that. Maybe it will be something like, okay, for 1 year we're going to provide you with housing, feeding, blah blah blah, but you have to come up with a great idea, and we're going to get 2% of your company when you do something like that. So the answer would be, how we respond to the challenges on ground today is what will determine what 5-10 years will look like. The world is changing very rapidly, and the speed of change is becoming increasingly faster than people can sufficiently adapt to it. So everything is just moving, blah, 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 blah. And you have to not only move with it, you have to move intelligently. You have to move with, changing times. The attitude VCs have tomorrow could change. It could change overnight. You have to adapt. There's nothing we say on this call that is law. There's nothing we say on this call that is binding, right? It could change tomorrow. And what do startups have to do? What they've always done, which is to adapt, to be able to take on the attitude of, we're going to figure it out, and we're going to move through, whatever problem that comes, and we're going to solve it. So general trend would be, I suspect that it will be harder to come across easy money. By easy money, I mean, you just bring up a deck, you're a good talker, you can just talk and they'll just give you money. It would still exist, but that would be the minority of people. And then you have to have really good networks, which social media, encourages anyway. So you should be able to capitalize on your network. You should look for actual problems. Like, if you go for real problems, trust me, money will find you. People will try to steal your idea, obviously, but you being the idea shepherd, money will find you. Money is going to gravitate towards you inevitably, because people will tell the authenticity of this person, the originality of, how you can tell when you're talking to two people, you can tell someone who this thing belongs to, this person is talking from themselves, or this person stole what they are saying from ChatGPT. The way you can intuitively tell is the same way VCs can intuitively tell when we know this one stole this idea, or this is the idea shepherd. Right? So being able to key in, look into your surrounding. There's so much problem in the world for you not to have a problem to solve. Too much problems. Is it food? Is it kidnapping? Create a startup around it. Solve that problem. Instead of complaining and putting something on WhatsApp, they've kidnapped another one. What will you do about it? Can you set up a neighborhood watch that will be tech enabled, so that even the gate man at the gate can send something on WhatsApp and is checking with the people back in the estate? Can you do that? Right? Those are the type of thinkings that the future demands, and it will determine the quality and the quantity of money that flows in your direction. And so that'll be all I'll say for today. Thank you so much for your time. I really appreciate it.
Thank you, Dami. But quickly, I just want
Okay.
you to share in less than 1 minute.
Okay.
Don't you think that the startup founders
Yes.
are trying to develop products that investors will be interested in?
Yes. Yes, that is 100% correct. And so it's like a chicken and egg problem, right? So the question is, which one came first? Is it that investors are looking for a certain type of problem, or founders are looking for a certain type of investor? It's hard to know which came first. But to make the change, you have to move out in faith. So for the investor, you have to move out in faith to to invest in type of problem you have not invested in before. For the founder, you have to move out in faith to say, look, rather than becoming fintech number 527, I would rather be kidnap prevention tech number 1 and fail at it. Like, I'd rather go out in that style. That is the that, just to wax a bit philosophical here, that's the call of the soul. That is when you are talking about who you really are. You can be a copy all day long, and you'll be begging for 100K here and there. If you come up with a serious solution that can solve Nigeria's pressing problems, all this nonsense that happens here and there, or in Africa, right? You come up with one. You don't worry about, finding investors. Just be putting the ideas out there. Put it out there. Put it out there. Over time, what's going to happen? One, your idea is going to gain traction in the mind of people, right? It would start, like, if you're putting it on TikTok, this is day 3 of 365 of me building Nigeria's first kidnap tech, blah, blah, blah. This is day 50 of this thing. Listen, before you get to day 365, if the idea is solid enough, a community will organically form around the idea. And you will be at the end of it. You will have more money than you need. After a while, you start telling people that you don't want money again. I've seen it happen too many times. The same way people crowdfund and say, oh, this person needs money for XYZ surgery. You can do that for your idea. And you show people, like, look, if you put in 100K, you are going to own 0.1% of the business. Over time, you'll find people, either many people will come around, or one really serious person will come around, pay for that, and you're off to the races.
All right. Thank you very much, Dami.
Thank you very much.
Quickly, Ebu, I want you to share the trends that business analytics and innovation financing that entrepreneurs and investors should prepare over the next 5 years as well. Ebu, you have created.
Yeah, I know. I was looking for
Okay. All right. That's
So, like, the trends over the next 5 years would be, I think,
Yes.
over the next 5 years. Can you hear me?
That's like your final word. Yeah, your final word.
Okay. I'll be quick. So I think over the next 5 years, financing decisions will become more data driven, right? So investors will want to see stronger revenue records. Like, I keep like saying this, maybe because of the nature of my job. So I clearer cash flow and better customer insight, and also more operational discipline too as well. So I also think that alternate credit scoring as well will grow just the way it is right here in the Western world. Do you understand? So, and especially using, I was going to mention earlier, like, I don't know, I was going to mention the POS, what is it called? I'm sorry, I'm just scattered. So I was going to mention it earlier in another question. Yeah. And also the digital payments, right? And the mobile money, um, transaction record. And so for entrepreneurs, I think analytics will no longer be something nice to have. It will now become something that is being fundable. Now investors will be happy to fund businesses. So I don't know if that has answered the question.
Yes, it does. It very much does. Thank you very much, Jeff. So,
right.
Success, there's actually a question for you, Success, and I want you to answer this question as your final words here. In a country like Nigeria, with unpredictable macroeconomics environment, what should startup focus on to have a sustainable cash flow?
Oh, okay. So Nigeria being very volatile. Startups that survive and scale are usually not the ones with the biggest ideas. They are the ones with disciplined cash flow management, strong unit economics, and products tied to real everyday pain points. So let's focus on focus on solving essential problems, not necessarily luxury problems. Focus on sectors people cannot easily stop spending on, even during inflation or currency shocks, like food and agriculture, healthcare, education, logistics, affordable, and all that. So, yeah, then also build for positive cash flow early. Many startups chase valuation instead of liquidity. In Nigeria, survival depends more on cash than hype. Prioritize fast revenue cycles, low operating costs, quick customer payments, high repeat purchases, lean teams. Start with lean teams and lean operations. So a startup should know customer acquisition costs, customer lifestyle value, gross margin, burn rates, cash runway, and if every new customer creates losses, scaling becomes dangerous. Also, if you need to get for pricing your products early, do that so that your fingers will not be burnt. Price for inflation, consider inflation, FX reality. Focus on recurring revenue. I will not overemphasize managing your working capital aggressively. So, as I said, essential products where that are not necessarily luxury problems, solve essential problems that cannot easily stop spending, that people cannot easily stop spending on. I hope that answers your question.
I'm sure it very much does. Thank you very much, Success. Thank you, all speakers. It's been a very impactful and insightful evening with Dami, with Emo, and with Success. And this is the May edition of the Tech Economy Business Series. I'm sure we also have like other events where you'll be able to share a lot more. I know you have a lot to share, but because of time constraints, 1 hour. Thank you everyone that has joined us for this webinar today. And looking forward to see you in the next session next month. Thank you very much and have a good evening.
Thank you very much and have a wonderful day.
Thank you so much. Bye.
Thank you. Bye.
Thank you, Mary.